Hi, it's Dre Griggs with Obsidian Wisdom. Today we discuss the October jobs report, rising bond yields, and how that impacts your stocks, gold, and other investments. So let's start with the October jobs report. In October, we added 531,000 jobs. Now, for comparison purposes, it was only estimated that we would have about 461,000 jobs. Now, you would be asking, well, Dre, what does that mean for my investments? Well, the long story short is it probably means a couple things. Number one, if you saw Chairman Powell this past week, he was talking about the likelihood of us maybe having higher interest rates a little bit longer than we were thinking and going into 2024. And that's because he has been raising interest rates because inflation had been at historical highs. We're talking about 50-year highs where we had 8, 9, 10% inflation, depending on what you're purchasing. And as a result, he started raising interest rates. So you'll see things like your mortgage, that's at about 7%, 8%. I've seen a couple at maybe 6.5%, but you see the mortgages are going up. But that also means you end up with a nice return when it comes to the bond market. The bond market in 2020, for comparison purposes, is about 0.5%. So you put your money in a 10-year bond, you got about a 0.5% return. When you compare that to today, you're almost at 5%, which is pretty spectacular. Imagine getting a 5% return on what we normally refer to as a risk-free treasury. Now, of course, when it comes to the government and the decisions that they make, we may not feel it's risk-free in the current environment, but historically, the government has paid its debt. Like that has been where you put your money at when you feel safe. And as a result, you're now getting a 5% return because the interest rates are so high. And because you can get 5% in what's considered a risk-free investment, that ends up putting negative pressure on some of those other sectors. For example, if you're investing in the stock market and you're getting 7, 8, 9, 10%, but you can get 5% in a risk-free treasury, well, more than not, people are going to say, well, let me go to the risk-free treasury. Like, why am I even going to risk losing my money in the stock market? Well, while that is a fair question, let me just go ahead and temper you first. First of all, remember, we said just in 2020 that it was at a historical low. So it was at like 0.5%. You're getting less than 1% in the bond market. Yes, it is up to 5% now, and that also includes the 30-year and the 2-year. I think I saw the 2-year was at like 5.2%, and the 30-year was at like 5.1%. So you are averaging a 5% return across the treasury bond market. But with that said, you often have to diversify your investments. You have to have an allocation in place that works in a variety of different market circumstances. And as I've told you before, we normally want to make sure we have investments that perform well in economic growth and economic decline. You also want to have investments that perform well in inflationary times and deflationary times. You don't want to be chasing returns in one particular market, and then when that market shifts, all of a sudden your investment portfolio is gone. Like everything, you're back to that 0.5%, and now you're like, well, dang, I should have been more diversified. So I do want you to temper your expectations where you don't just go all in on the bond market because we're now getting a 5% risk-free return. We know just a few years ago that was less than 1%. So as a result, you normally take the opportunity to invest in some really good sectors that aren't performing as well in high inflationary times, because when we get back to those deflationary times, then things will normally change up. So for example, some of you that like dividend performing stocks because you want that extra income, well, they don't normally perform very well in high inflationary times because as the bonds go up, we end up saying, well, dang it, I'm going to get 5% over here and I'm going to get a little bit of income. Versus the average dividend seeker who is normally investing for the dividend and they're not necessarily expecting a lot of appreciation of the asset. So for example, the utility sector has dropped 11% since mid-July, and the consumer staples sector has lost 9% since July. And that's for many people, the 5% risk-free return normally outweighs the opportunity that they were getting in their dividends. So as a result, the sectors where a lot of people are investing in for dividend reasons, those are going down, which normally means it's a great time to invest in them. The utilities and the consumer staples are going to be here, especially if you think about it from the perspective of if we keep raising interest rates, historically, that means we normally go into a recession. And if you go into a recession, where are you going to want to invest your money? Back in those consumer staples. Because when there's a recession, people don't spend on luxuries, they don't travel, they don't do all the extra stuff. But you got to get the consumer staples, like toilet paper and things that you just have to have. So you need like food, toilet paper, things like that. So they normally perform well in a recession. So you don't want to just leave it knowing that the next part of the economic cycle will put you smack dab in the consumer staples. So you do want to be able to diversify, as I have mentioned to you before. Also, you notice that the higher treasury bonds has negatively impacted mortgage-backed securities and corporate bonds. And the idea is if I'm a business and I have to go get a loan, well, now the interest rates are much higher. Because the interest rates are much higher, maybe the company is no longer able to get the money that they need to reinvest back into the corporation so that they can grow. Also, when you think of a mortgage, if the mortgage is at like 6, 7%, like I mentioned to you earlier, well, that also means that a lot of people aren't going to be able to get a mortgage anymore. Or if they do get a mortgage, it's going to be a lot less house than it would have been. Where if you can get a 2 or 3% mortgage, you can get a lot more house than if you had a 7% because the monthly payment is a little bit higher. For most of us, when we get approved for a loan, it's approved based on our debt to income ratio, and they tell you how much you can spend per month on whatever you're buying. Well, if the interest rate is higher, that means you're going to have a higher monthly payment even though you have less house. And as a result, mortgage-backed securities and corporate bonds have also gone down because of the high returns that people are able to get on their treasury bonds. Gold is a little bit of a mixed bag. So on the one end, because the treasury yield has gone up, gold has gone down because gold doesn't pay any interest. But because of the Hamas-Israel war, gold has gone up because when things get crazy, people normally invest in gold. So even though there's a point in time within the last 30 days that gold was at a 7-month low, when the war started and as things became more uncertain, more and more people started investing in gold again because that's where we go. Whenever there's something going on negatively, whether it's like COVID or recession or just a war or anything like that, more times than not people invest in gold because that's the safe haven. Normally, if you have a percentage of your portfolio, I've heard people say 0% where you shouldn't have anything in gold. I've heard people say 5, 10%. I normally say let's just have a small portion in there because if there's ever a time I need to be 25, 40, 50% invested in gold, there's probably so much wrong with the world that being invested heavily in gold is going to be the least of our concerns. The last thing we'll talk about today is the US dollar. So as bond yields go up, the US dollar also goes up. So you'll see that we've actually gained 7% since mid-July. As the dollar becomes more valuable, you get to spend less money on gold. So you'll normally see it has an inverse relationship to gold. As gold goes down, usually the dollar will go up because I'm able to buy more ounces of gold with fewer dollars. That would also be true with things like oil and other commodities where as the dollar is worth more, I'm able to buy more resources with a fewer amount of dollars. So right now the dollar is doing pretty well because of the higher treasury bonds. Hopefully what you'll notice is there's a relationship between the stock market and your dollars and your bonds and gold and all the different things that you'll invest in, even real estate and mortgages, businesses and their growth, where if you're able to see something, and that's why a lot of people listen to Chairman Powell, because we know that based on what the Fed is going to do, it's going to have a ripple effect across the entire economy. And because no one expects the interest rates to be decreasing anytime soon, largely because of the strong economic growth that we've seen over this last month, a lot of people are finding investing in these treasuries is a good place to invest. But again, I would caution you on the importance of a diversified portfolio because these economic swings are going to happen. There is going to be a time where the rates are increased too high and it's going to cause us to dip into a recession. And oftentimes that economic shift is going to cause different assets to perform better than are currently performing. If you found value in this video, I simply ask for you to like and subscribe so you can continue receiving valuable information on how to solve generational wealth through strategic retirement planning. Until next time, stay safe and enjoy life.